Hello, everyone, and welcome to the channel. We were promised that the free market would sort everything out. Instead, we now have governments with debt near 100% of GDP, throwing subsidies like confetti and calling it strategic autonomy. If you ever believed in the invisible hand, this is the part where it shows up with a very visible invoice. The core conflict is simple. After 40 years of preaching minimal state intervention, the West is quietly moving back to heavy-handed economic management. Subsidies, tax breaks, sanctions, industrial policy, binational rules, all the tools that textbooks used to call distortions are now rebranded as resilience and security. And this matters directly for prices, jobs, and stability. Because when the state comes back into the economy with this level of debt and demographic decay, it doesn't bring free money. It brings trade-offs, inflation risk, and long-term structural shifts that someone, usually taxpayers, will finance. Let's start with the basic reality. This isn't theory, it's line items and budgets. The U.S. Inflation Reduction Act alone creates hundreds of billions in clean energy subsidies over a decade. The EU answers with its own Green Deal industrial plan, loose state aid rules, and huge funds for chips, batteries, hydrogen, defense, and everything else that fits under the word strategic. Add to that ongoing military aid packages, rearmament, and support schemes for households and companies after energy price shocks. The invisible hand at this point is sitting in the corner with a drink, watching procurement departments run the economy. Here is where the story stops making sense. Classic liberal economics assumed relatively low public debt and young growing populations. Now we have the opposite. Many advanced economies are at or above 100% of GDP in public debt, with aging societies that consume more and produce less. The old recipes of just stimulate demand or just cut taxes and deregulate collide with brutal arithmetic. Interest on existing debt, pensions, healthcare, and now gigantic subsidy schemes for industry and war. If you remember only one thing from this video, let it be this. When the state returns as the main economic actor at this scale, it isn't a free lunch, it's a forced restructuring. On the money and physics level, it looks like this. You have limited real capacity factories, energy systems, logistics chains, workers. You inject massive fiscal support, grants for chip plants, credits for green tech, defense orders for ammunition and missiles, support to shield households from energy bills. If supply cannot keep up, you don't just boost growth, you also fuel inflation and misallocation. Capital flows not to the most productive projects, but to the most politically protected ones. This is the part no politician wants to explain on TV, because we're supporting strategic sectors sounds better than we are locking in inefficiencies that you will pay for on your tax return. The players and incentives are also quite transparent if you drop the slogans. The US wants to maintain technological and financial dominance. It uses sanctions, export controls, and huge domestic subsidies to pull production back home and away from China and increasingly from Europe. At the same time, it pressures allies to align on its industrial and energy preferences, even if it raises their costs. Europe talks about green transition and open markets, but in practice is moving to its own protectionism. Carbon border taxes, loose state aid for national champions, European sovereignty funds. Russia, under sanctions, is forced into a war economy, with the state directing industry, labor, and finance toward the front. China has been running its own version of state-guided capitalism for decades. Controlled credit, industrial targeting, huge support for exports and technology. Here is where the story stops making sense for the second time. Everyone publicly defends rules-based trade, but behind the scenes they weaponize everything. Tariffs, standards, currencies, energy flows, supply chains, IP rights. Sanctions have become a normal tool of competition, not an exception. That means planning horizons for companies shrink. Why invest for 20 to 30 years if your supply chain, market access, or financing can be shut down by a sanction package or a change in alliance politics? If you're running a factory in Central or Eastern Europe, you now live in a world where Washington, Brussels, Moscow, and Beijing can all change your business model with one signature. For ordinary people, especially in Europe and the Baltics, the return of the state into the economy looks much less heroic than in the policy papers. It's higher taxes in various disguises, from carbon pricing to solidarity contributions. It's higher energy bills, where part of what you pay is no longer just for electrons or molecules, but for transition funds, compensation schemes, and industrial subsidies. It's higher interest rates because central banks are trying to fight inflation that was partly triggered by massive fiscal intervention combined with supply shocks. And it's more pressure at work as companies are told to adapt to new rules, new reporting, new ESG requirements, and new geopolitical risks without any guarantee of stable markets. If you're in Germany or Poland, I'm curious how this looks from your side. Do you feel this as a serious change in how the state behaves, or is it just background noise under the usual politics? From Lithuania, I see a clear pattern. Governments that spent decades outsourcing responsibility to the market are now rushing back in, but with degraded administrative capacity and much worse balance sheets. There is also a psychological dimension nobody likes to mention. When the state becomes the main customer for energy projects, weapons, infrastructure, green tech, the line between economic performance and political loyalty blurs. Lobbying becomes more important than innovation. Survival of the most connected replaces survival of the fittest. In theory, industrial policy is about fixing market failures. In practice, it often creates state-managed oligopolies that are very hard to dismantle later. This is the part no politician wants to explain on TV, especially during elections. At the same time, simply shouting statism is bad is equally stupid. Pure laissez-faire never really existed, and complex systems like energy grids, healthcare, railways, or large-scale reindustrialization do require coordination and long-term planning. The problem is not that the state is back. The problem is how it is back, late, indebted, under demographic pressure, and trying to manage geopolitical confrontation, green transition, and social stability all at once with tools designed for calmer times. For households, this means more volatility, not less. Prices that move with policy announcements, jobs that depend on which sector has political priority this year, pensions and savings exposed to both inflation and financial repression, as states quietly prefer higher inflation over explicit default. If you're in Southern Europe, does this match your reality, or is it still wrapped in Brussels' fantasy language about shared prosperity and next generation plans? If you remember only one thing from this video, let it be this. The era of the neutral state standing aside from the economy is over. The state is back in the cockpit, but the fuel gauge is blinking red. The crew is aging and the passengers are told to clap and believe in resilience. In the end, the slogans about markets versus the state are mostly theater. What really matters is whether the systems we build, fiscal, energy, industrial, social, can actually function under stress without collapsing or eating their own populations alive. Thank you for watching. Take care of yourselves and your loved ones, and try to remember slogans don't power grids. Systems do.